Welcome to The Prescription, the Tax Policy Center's biweekly webcast on fiscal policy for the COVID-19 economy. This is one of a series of conversations with state, local, and federal government officials, as well as leading economists and other experts. I'm your host, Howard Gleckman, a senior fellow at TPC and editor of our blog, TaxBox. Our guest today is Alan J. Auerbach. Alan is the Robert D. Birch Professor of Economics and Law at the University of California, Berkeley. He also is a research associate at the National Bureau of Economic Research. In 1992, he served as Deputy Chief of Staff of the Congressional Joint Committee on Taxation. Alan has a forthcoming book entitled Taxing Profit in a Global Economy, co-authored with Michael Devereaux and John Vella of the University of Oxford, Mick Keane of the IMF, Paul Oysterhouse of the law firm Skadden Arps, and Wolfgang Schoen of the Max Planck Institute in Munich. Both Alan and Mick are winners of the National Tax Association's Daniel M. Holland Award for Lifetime Achievement in Public Finance. Before we begin, just a bit of housekeeping. We encourage audience members to submit questions in the Q&A box at the bottom of your screen. The event's being recorded and will be posted online at TPC's website. And if you'd like to join the conversation on social media, please use the hashtag #LiveAtUrban. And if you'd like to suggest a future guest for The Prescription, just email us at info@taxpolicycenter.org. Alan Auerbach, welcome to The Prescription. It's great to have you.
Thank you very much, Howard. If I could just add one thing to your introduction, that book is now out. It's just appeared, and it is not only available from Oxford University Press, but we've arranged so that people can download it for free in a PDF version. And that is currently posted on the Oxford Center for Business Taxation website. And you can also get a link to the book on my own website, either the individual chapters or the entire book itself.
Great, and we will send that PDF to everyone who's registered for the event as well. So everybody who's listening to this will get it.
Great.
So great. So before we start on the problems and the solutions, let's step back a bit and let me ask you, what's the purpose of a business tax? You know, my TPC colleague Steve Rosenthal argues that a business tax should be based on the principle of benefits. Countries ought to collect taxes from businesses that exploit their resources, such as the labor force and infrastructure. Others say the purpose of business tax is to collect taxes on income of a country's residents that are not captured by individual income taxes. Where do you land on this?
Well, we actually devoted a lot of time thinking about this in a chapter in our book, talking about this. And in the end, we confronted the benefit approach, the backstop for individual taxation approach. We concluded that in general, none of the standard justifications for business taxation make sense. Of course, it depends a little bit on whether you're talking about a developing or developed economies. In developing economies, that may be the only way they can collect taxes. They may not have the infrastructure to collect taxes from individuals. But for a country like the United States or a typical OECD country, there are choices. And particularly in the current environment where you have multinationals crossing borders, shareholders in every country, thinking about the tax as acting in lieu of taxes on shareholders doesn't really make a lot of sense. And benefit taxes, well, appealing in principle, don't really align very well with the way corporate taxes are actually designed. So these and other explanations, are a bit wanting. In the end, we just took the pragmatic view that countries are going to have business taxes. They're not going to get rid of them. They're not simply going to tax their residents. And so in light of that, we'll just try to come up with our ideas of what tax systems look better.
So you'd evaluate business taxes on 5 factors. 4 of them, efficiency, fairness, difficulty of avoidance, and administrability, are very familiar to people. They apply to almost any domestic tax. But the 5th, incentive compatibility, is a bit different. Could you explain what you mean?
Sure. The problem is when countries try to reach agreements, whether it's about taxes or global warming or anything else, when they reach agreements that leave the world better off if everybody complies, that isn't necessarily enough, because if an individual country can do better by deviating, either by not imposing the carbon tax in the case of global warming, or in the case of taxes, not imposing tax rates as high as other countries. They can engage in tax competition, attract, get multinationals to shift profits to their country, get them to shift activities to their country. And the current tax system, by and large, encourages countries to compete, which is one of the reasons why we've had corporate tax rates going down around the world over time. And we were trying to come up with approaches that satisfy incentive compatibility, meaning that countries have, not only will the world be a better place in terms of tax, the other criteria, if countries adopt such an approach, but individual countries don't have to be coerced by other countries to adopt such a system, that it would be in their own interest to do so if other countries do. And therefore, it's a self-reinforcing system.
So based on this 5-part test, how would you say the current international system fares? If you're going to give it a grade, what grade would you give it?
Well, either a pretty mediocre one. I mean, it's a little hard to say because the tax system is evolving. I mean, the US has a new tax system that's only a few years old, and other plans are underway in other countries. But I would say it's very haphazard. There are all kinds of anti-avoidance rules. The US has them, Britain has them, other countries do. There are ad hoc taxes being thrown on, digital services taxes in some countries. And nevertheless, countries continue to lower their corporate tax rates. If you look at a trend over the last few decades, it's been pretty steadily downward. And the incentives are still there for countries to compete. So I think I don't want to choose a specific letter, but it's not very good. And it's not so much that that we've gone in the wrong direction. It's that we're working with a tax system that was designed in a very different era, and the economies of the world have changed so much since the initial tax system was basically designed that we keep trying to patch it, and we're not doing a very good job at it.
Well, actually, I'd like to explore that a little more. So is the fundamental problem that countries are trying to repurpose a tax that was designed for profits made from the sale of manufactured goods into one that fits a world where returns from intellectual property are really the story?
I would say there are two factors. Intellectual property is one. And if you think, well, what are the problems of intellectual property? The problems are, number one, it's hard to say where it is because it's in the ether. It's not really in any particular place. And therefore, bringing in the second factor, if you have more activity by multinationals, it's easier to shift profits across borders. So if you go to an old model where you had manufacturing by a company that operated in a particular country and then exported, you not only knew where the profits were being earned, but it was very difficult. It would have been very difficult anyway for the company to shift profits because it was only operating in one place. So you combine the greater reliance on intellectual property and the much greater scope internationally of countries in terms of where their operations are, and you're left with a much greater difficulty enforcing the kind of tax systems that we have.
So let's talk about solutions. The book actually describes two related but quite different destination-based models. The first, which got a good bit of attention during the debate over the 2017 Tax Cuts and Jobs Act, is the destination-based cash flow tax, the DBCFT. Could you briefly describe that one for our viewers?
Sure. There are two ways of describing it, and we usually use different ones depending on we're talking to people who live in a country that already has a VAT, which in this case we're not. I mean, if you had a VAT, you'd say, well, start with the VAT. Instead of having a so-called credit and invoice method VAT, have a subtraction method VAT, and then allow a deduction for wage and salary compensation. An alternative way of getting to the same answer is to start from the existing corporate tax, broaden it to a business tax or a tax on large businesses, so it covers not just C corporations, any business that is likely to have international operations. Move in the direction of a cash flow base. By eventually getting rid of interest deductions and allowing immediate write-off of investment. And then add to that a border adjustment so that it's not a tax based on the earnings in a particular country, but like a VAT, moves the tax base to a destination by saying if it's for export, you get a credit for the sales revenue, and if it's an import, you have to pay a tax on the import.
So you actually raised an interesting question for me, which is this proposal is the economic equivalent of a VAT with a wage subsidy, and since nearly every country in the world has a VAT, why don't you just build on that and just kind of make this a VAT with some adjustments?
Well, there are a couple of reasons. Number one, the U.S. doesn't have a VAT, and some of the authors of this book live in the United States, and it's pretty hard to come up with a proposal that starts from something that the most important country involved doesn't do. I think also our view is that VATs in most countries have sort of are bases that are too narrow. They also don't deal very well with typically don't very well with financial businesses. They've come up with ad hoc approaches. And so we started from first principles, and we said, okay, suppose we were going to design a cash flow tax, leaving aside for the moment the destination based piece, and we were going to do it in a way that it was broad based and included, integrated within it a treatment of financial institutions. What would it look like? We could have said, well, let's start with the VAT. Let's think of how we'd reform it. But we do talk about that in the book in terms of implementation. We say there are two different ways of implementing the DBCFT. One is by starting from a VAT and doing a bunch of reforms, and the other is by starting from the existing business tax. But you could do either.
And would you expect that if this became was caught on among different nations, that different nations would approach it in the way that was most appropriate for them? So countries that already have a VAT would just adjust the VAT.
They certainly could. And to get to the issue, get back to the point about incentive compatibility, one of the strong advantages we see of the DBCFT is if a country like the U.S. and I don't think there's even people who don't necessarily favor the DBCFT would admit this, that if the U.S. had adopted the DBCFT in 2017, there would have been enormous pressure on other countries to do so too, because it would have made the tax on operations in the U.S. essentially zero. And so if tax havens were a problem, the U.S. would have been a really big problem. It wouldn't have been a tax haven. It would have been a country with a legitimate tax system and real operations, but it would have forced other countries to move in the same direction.
So the alternative proposal is the residential profit allocation by income, the RPAI system. It's also a destination-based tax, at least in part. However, it retains the basic structure of a corporate income tax rather than creating a cash flow tax. How else does it differ from the DBCFT?
Well, I think it's easier to think about how it differs from the current system. Because, and in fact, you can think of these two proposals as, suppose you were starting with an almost blank slate and you were trying to design a tax system that worked, what would it look like? Suppose instead you believe in the adage that old taxes are good taxes. Somehow people have adjusted to the current system. They know there are problems with it, but you'd like to try to make an incremental move away from the current system rather than moving to a very different one. What would you do? Well, you mentioned the biggest problem has to do with intellectual property and the shifting of profits. And the general view, and of course, on this, among our authors are a few very prominent tax lawyers who educated the economists about where the particular problems are. And so the issue is it's not the manufacturing. To the extent you have manufacturing or other routine operations, the existing system works okay in terms of measuring where profits are earned. And so we said, well, let's focus. If we were trying to work within the current system, what would we do? We will take those profits that are unallocable, to standard operations. So the companies are making a lot of money, and you can't say, well, that's from their manufacturing plant or something else. We call those residual profits simply because they can't be easily attributed. And then we basically use a sales apportionment approach slightly different. We apportion based on an adjusted income measure rather than sales, but it's close. So it's similar to the sales apportionment that we do among states, and most states now are doing in the U.S. But we don't do it for all profits. We just do it for these residual profits that are hard to allocate. And the argument is that, well, it doesn't go as far as the DBCFT and killing opportunities for profit shifting. It makes it a lot more difficult because it makes the profits that are hard to allocate by default allocated according to the location of revenues.
So I wonder if we could use a concrete example. Let's take a company like Facebook, just to take company at random. I wonder if you could kind of give the audience a sense of how Facebook would be taxed under each of these systems and how it would be different from the current system.
Well, under the DBCF, first of all, I will say that digital services companies in general pose, are the hardest companies to think about.
Right.
Under a DBCFT, Facebook would, get revenues from, if we're assuming every country has a DBCFT, Facebook will get advertising revenues in some countries. It will pay tax on them. The real key there is that, and thinking about, the way VATs work, think about the companies that are advertising on Facebook, that are making their money on Facebook. So those companies, I'm a bicycle manufacturer in the UK, and I'm trying to sell bicycles in France, and I spend advertising revenues. I purchase advertising from Facebook, and it shows up for French viewers who then decide to buy my bicycles. I pay tax on the bicycles in France under the DBCFT because that's where they're delivered. Facebook may have charged me for advertising in some low tax country, and so I may not have paid tax. Facebook may not have paid tax on that. On the other hand, the company that sells the bicycle in France doesn't get a deduction for the advertising expenditure either. And so the tax may not be collected from Facebook, but it could be collected on the final sale of the bicycle. And so, in the same way that VATs, you tend to think of the tax ultimately being on the final consumption good. It would be a tax on the final consumption good there. The only difference would be that Facebook would deduct employee expenses wherever it is. Under the RPAI, Facebook presumably would have most of its revenues or most of its profits would be unallocable. Facebook would be an extreme version of it doesn't have any manufacturing activities, doesn't have any, I'm sure it has some activities, it has employees and so forth, but most of what Facebook gets is a return to intellectual property. And that would be allocated according to where revenues are placed. And here's a key challenge in the case of Facebook, because Facebook's users are, getting services from Facebook. You wouldn't want to allocate the taxes to, say, where Facebook makes its advertising sales, in some low tax country, but where the users of Facebook are. And so you have to there's a judgment called required, and this comes up in other contexts as well. And I think that would be, for digital services companies, you'd have to do it based on where users are.
So the OECD is struggling with this whole question as well, and they've designed what they call Pillar 1 and Pillar 2. And we actually got a question from a viewer, which is, how does the RPAI differ from Pillar 1 that the OECD has proposed?
So the RPAI, I think you could, frankly, the RPAI influenced the Pillar 1 design in the sense that there's a destination component in Pillar 1, which I think reflects the ongoing thinking we've had in our group. It's much more complicated. The Pillar 1 approach it has a destination component, but it also tries to allocate residual profits to, in some cases, to where production occurs and where key personnel are. It's complicated, and I think it reflects an attempt to satisfy all participants in the process, and thereby satisfying nobody. I think it'll be very. It's really too complicated, and one hopes that it'll converge more in the direction of where we came out. I mean, we're allocating everything based on sales, and there'll be some countries that are unhappy about that, and I think that reflects what the OECD is trying to do. But the whole point of allocating residual profits based on the location of sales is that we think that's really the only stable way of doing it.
Let me ask you about a couple of alternatives. There's of course, as you talk about in the book, there's lots and lots of ways to try to deal with this. President Biden seems to be going in a very different direction from you and your co-authors. Instead of moving to a destination-based tax, he continued to tax firms based on corporate residence. But Biden would increase those taxes by raising corporate income tax rates and by raising and broadening the guilty minimum tax that was opted as part of the TCJA. Does that approach seem viable to you?
Frankly, I fear no. There have been currents in the U.S. for many years in different directions. Prior to destination-based taxation becoming more prominent, there was a sort of two views: one that we should go in a direction of a territorial system, and one we should go more toward a worldwide system. And those are typically associated with Republicans and Democrats, respectively. And this is a more vigorous movement in the direction of a worldwide tax system than the Obama administration proposed, in that the so-called guilty provision, the provision that imposes the tax on U.S. companies' operations abroad, they would raise the tax substantially. They would get rid of the deduction based on plant equipment investment abroad. So it would really, and because that's a tax on accruing earnings, and they would also institute a per country calculation rather than an overall calculation, it would move us really pretty close to a worldwide tax system for U.S. companies. And the basic problem with that is that a worldwide tax system for U.S. residents, individuals, makes a lot of sense. But a worldwide tax system for U.S. companies really doesn't make a lot of sense, because the idea of a U.S. company as distinct from a company in another country is just becoming less and less sort of sensible. Now, yes, you can combine it with restrictions on corporate inversions, which is one natural response to a country trying to undertake a stronger worldwide system, and the U.S. has done that. Did that during the Obama administration. But I think ultimately you have to ask yourself whether that's what you want to accomplish. That is, trapping companies that are already U.S. companies in the form of U.S. companies, and not thinking about what that does to the next generation of companies that come along. Our response is, well, people don't think about that when they start companies. But I think they're ultimately going to be, it's sort of a guerrilla war between tax authorities and smart tax lawyers. And, I understand there's smart tax lawyers in governments too, at least for a while, until they go off and go to the other side and make life difficult for the government. But I think ultimately, coming up with an approach that causes the incentives of companies to align with the government rather than trying to fight with them all the time is a better strategy.
So the book is very timely, and we talked a minute ago about the OECD, and it's continuing to struggle to develop a uniform plan to tax digital services on a destination basis. Yet progress has been slow, and discussions continue. Member countries are going their own ways and imposing their own new taxes on revenues generated in their own countries by these digital firms. What are the effects of this process, and why should they concern us?
Well, from a political point of view, digital services taxes are taxes on large U.S. multinationals. And so, when we're just taking a nationalistic view of international taxation, the U.S. shouldn't be very happy about that. I think one should think more about it and just take a broader perspective than just that. If one wanted to be an optimist, you could say that digital services taxes are filling a void right now. That because we don't have very good tax systems, and particularly for dealing with companies that are in the digital services area and have a lot of profits that aren't really being taxed anywhere. If you come up with a better tax system, like the two we have in our book, or some other variant, one which sort of incorporates destination as a tax in principle, you won't need the digital services taxes. So I would hope that and I think the OECD's view is has the same view, that if you could adopt sensible reforms, the need for digital services taxes, or the perceived need for digital services taxes, would go away, because they would essentially be incorporated in the new framework.
So the U.S. has really not been in the game for the last several years. The OECD has been doing this on its own. The Trump administration was very critical of any sort of multilateral negotiations about anything. The new Treasury Secretary, Janet Yellen, has expressed far more interest in a multilateral approach than her predecessor did. Are you optimistic that maybe the U.S. will become more engaged?
I think it would be great if the U.S. did, because I think the U.S. Could have a big impact on the final version of the OECD plan. And you mentioned, you asked me about the difference between the RPAI and Pillar One. I think, that could be something that could be influenced by the U.S. It's sort of funny, because the Biden administration has its own proposal, and at the same time is, open to cooperating. And so one would hope that they would, at least defer adopting major international tax changes until they at least saw where the OECD was going, so that they could try to adopt something that was consistent with what other countries were thinking of doing, rather than going in a different direction.
So you talk a lot in the book about the importance of cooperation, but you also say it's very hard to achieve. Can any reform succeed without a broad multilateral consensus?
Let me give you a good example. When the DBCFT was under consideration in the US, the US was going it alone. They were saying, at least initially, they were saying, this is what we're going to do. And it caused a lot of unhappiness abroad. There were, suggestions of a WTO challenge. If the U.S. at that time, I've emphasized that that approach is incentive compatible. If the U.S. had done it, other countries might have been forced to. But I think a better way of going would have been for the U.S. to say, we think this is a good way to go, and talk to other countries about it, and try to get them to cooperate in phasing and adoption of that plan. And I think if they had, a lot of other countries would have seen the benefit of doing it, would have gone along. But when confronted with, the U.S. saying, here's what we're doing, too bad, I think that's not helpful. And so that's an example where cooperation would be encouraged by the incentive compatibility of the approach, but it still would have been better to have cooperation than to just act unilaterally.
So we just have a minute or so left, and I want to ask you a domestic political question. So any fundamental change in corporate taxation is inevitably going to create winners and losers. You learned that with the DBCFT debate in 2017. The winners accept the benefits without thanks, and the losers loudly object. So how do lawmakers overcome this dynamic?
Well, I think you've actually got two problems. One is you've got actual winners and losers, and the other is you've got people who think they're losers who aren't, which was part of the problem with the DBCFT. One of the standard answers for, in the tax reform world is either you have a tax cut, which makes everybody happy, or come up with something that's such an improvement in the tax system that there aren't as many losers as there are winners because of efficiency gains. I think, some combination of those. I think we've kind of, we've lost our option of the tax cut over the last several years, and so we have to rely more on the second argument. And I think that just means you have to come up with a better tax system, and then try to make both explain to people why it is a better tax system, and not just assume it's self-evident, and then hope you can get it through.
Great. We are out of time. Alan Auerbach, it's always a pleasure to talk to you. Thanks so much, and best of luck with the book.
Thanks, Howard.
Thank you, and thanks to our audience.